Well, good morning and happy belated Easter, everybody. I am joined with my colleague, Neil Sobchak. I think Neil was on the last meeting. Neil really helps me support this relationship, making sure that you feel supported, that you have everything that you need. So I've asked Neil to kind of help participate in these meetings and help provide an update to you all. And then also my colleague, Raj Khan, is joining us. I think Raj has joined meetings prior. Raj is the head of research at Wespath. So he does a lot of that work, the projects that we are doing, looking at all of our funds, primarily the equity funds and the multiple asset fund. Raj is spearheading a lot of that analysis and work. And I know we're going to talk about performance in depth, about a lot of the work we're doing in the funds and past performance, and talk a little bit about some of that work that we're doing. So I wanted Raj to come on and to kind of give us those details about that. So I'll just kind of kick us off, and then I'll turn it over to Neil to talk about your accounts. Neil also pulled in some data because obviously the quarter was pretty volatile, and then we had the end of the quarter, which unfortunately the volatility did not stop and still hasn't stopped. So give a little bit of an update on your accounts, and then also Raj and I have some updated market return information and so forth. Dustin, one thing I do, and I'll share the presentation with you after, we did create some additional tariff slides and manager information about like how they're their thoughts on the tariff. So I will send this presentation to you after. It's just all of that stuff was created after the deadline to get the report out.
Very good.
So just a reminder, we like to disseminate information about what's going on and try to be up to date as much as we can. So we posted a letter from our Chief Investment Officer, Jahara, regarding market reactions, impact of these events to our investors, and our long-term strategy. You all should be receiving these. So if you are not, please let me know, and we can look into that for you. So with that, I'm going to turn it over to Neil, and you just let me know, Neil, when you need me to turn slides.
Yes, thank you, Karen. Take a few minutes here to look at our account balances before we turn it over to Raj and talk about some of the more juicy market stuff and the crazy market swings and how the U.S. Treasuries have been trading like risk assets. So we'll get into that. But to start here, and we're going to do our best balancing act. A lot of what you see here in the deck is as the end of quarter one. But I am going to, as Karen mentioned, try to loop in some of the most up-to-date information as of close of business yesterday. So end of quarter one, total market value for your 5 investment accounts at 67.7 million. The lion's share being allocated to the Kansas balance account that ended the quarter at 44.5 million. So now here's where we can take a forward look, and through the end of yesterday, this market value did drop by about 2 million. So just keep in mind that's not a pure don't think of that as a capital depreciation figure, because that would be a pure market value figure that factors in flows. But as of yesterday, about 2 million down given the volatility. All right, thanks, Karen. It says the Kansas balanced account. So let's focus on the quarter to date performance here. You can see it returned negative 60 basis points versus its benchmark of about negative 30 basis points. The story here is, if you look at the allocations in this portfolio, it was really helped by the fixed income fund, that 36% allocation to fixed income. That fund was up about 2.5% for the quarter, and the portfolio was helped by the international equity fund as well. So that fund was up about 3.7%. Mm-hmm. On the U.S. equity side, we have an allocation of both the active and the passive U.S. equity funds, and both had almost identical returns for the quarter, and they were down by about 4.7%.
One thing I'll just add is, as we remember, so October 1 is when we made the shift in the balance fund from the multiple asset fund. So we removed the inflation protection fund, we added in the US index fund, and we lowered international to 20% from 30%, which was a great move for the fourth quarter because we did see those mega cap stocks continue to do well. So it sort of lessened the small cap, mid cap overweight that this portfolio had and made it more market like, so US market like. And that worked again, like I mentioned in the fourth quarter. Well, as Neil mentioned, we really saw this rotation in the market in the first quarter. And Raj will talk a little bit more about that. But on February 19th, we really saw international stocks pick up pace and the US markets really fall back. And primarily the fallback was in those mega cap stocks. So the shift in allocation did not help in the first quarter like it did in the fourth quarter. But again, I always like to remind us that when we make these shifts in the portfolio, it's really for the long term. I mean, we didn't do this because we're trying to time the market or anything of that nature, that we really wanted to position the portfolio that was best going to allow you to be successful with your investors and create a balanced portfolio that they would expect and want to invest in with the allocations.
All right, let's take a look at the Kansas fixed income account. Ended the quarter at just shy of 9 million. But again, if we focus on the quarter to date return here, very pretty much in line with its benchmark at a positive 2.5% return. Again, this account is 100% allocated to fixed income fund. So a standalone here in fixed income, but when I think of the fixed income fund, I think about its place in a more balanced portfolio. So I think about this 2.5% return and say that that's a pretty solid return, and fixed income is going back to acting as the ballast as it should for balanced portfolios. Kansas equity account ended the quarter at 7.8 million. So the quarter to date return here, negative 2.3% versus benchmark return of negative 2%. So looking at the allocations here, we know from the balanced account, the US equity position, so about 70% allocated to US equity at that negative 4.7% return for the quarter. And international equity, that 30% allocation really did help. And as I mentioned, it returned about a positive 3.7% for the quarter.
Yeah, so very similar comments as with the balance fund. October 1, we increased the US equity index fund from 20% to 30%, which again benefited before, and then just slightly detracted for the first quarter. But again, we always want to think about positioning these portfolios for the long term and not try to get swayed by what's going on in the current market.
All right, the Kansas equity index account ended the quarter at about 1.7 million. We've spoken about these returns, negative 4.7% for the quarter. We can go a little bit deeper once we reach some of the fund performance slides towards the end of the deck, Karen. And then the Kansas short-term account ended the quarter at about 4.8 million. Quarter to date return of 1%, right in line with its benchmark. We have about the 4.8 million allocated here, but I always like to point out that look at that 1 year return, that 4.9% return, just a really healthy return for a cash-like fund as the short-term investment fund is. Obviously extremely low risk here. I mean, that's really the best returns we've seen from the short-term investment fund since it incepted in 2002. All right, a quarterly snapshot is what we're looking at here. I like to look at the aggregate level at top, that total fund level. Gives me an idea of the flows for the period. Contributions at the aggregate level, 1.8 million, largely came from the Kansas balance account, and withdrawals of about negative 7.3 million. Again, that was driven mostly by the Kansas balance account. And then that capital depreciation figure, it does strip out the noise of those flows. So purely for a capital depreciation figure, The portfolio was down about 123,000 for the quarter. Yeah, any questions?
Yeah, thanks,
Yeah, I
Sam.
just thought we'd pause for any questions there before we shift it over to Raj.
I'll just say also Neil, you spoke about it declining an additional roughly $2 million since the end of the quarter. We actually made the full distribution of all of our permanent endowments in that period of time. So it wasn't all related to market. It was also related to us pulling funds out, would be my guess.
And what was the date for that, you said?
We pulled a pretty significant amount out about 10 days ago.
Okay.
For making distributions. So we're timing our permanent endowment fund distributions right around Easter. And so we pulled out some of those funds in the last few weeks. Thank you.
That makes sense. And I failed to mention, but I did have the up-to-date information on each account by account and what the unrealized gain loss looked like and the ending market value, if that's something we want to dig into.
Okay, thank you.
Mm-hmm.
Any other questions? Okay, Raj, I will turn it over to you. And as I mentioned, Dustin, we do have a few extra slides in here that were pretty new. So I'll make sure to give you the updated deck after the call. So Raj, I'll turn it over to you.
Good morning, everyone.
Hey, Raj, I can't really hear you.
How about now?
Still vague, it seems like it's the sounds coming from your your camera.
How about now? Is it any better?
Yeah.
Okay, great. Sorry, last minute technical adjustments here, but I'm glad you can all hear me. So thank you, Karen, thank you, Neil, and good morning, everyone. Really good to join you all. Market performance explanations. It is getting harder and harder because markets are moving so quickly right now with every information that becomes available. There are quite a few slides, and as Karen mentioned, some new were added. So I'm going to try and first provide a broad market update, and then we can go through the slides a little bit quicker, just keeping an eye on timing. Please stop me and ask me questions. But we've seen so far this year markets move very drastically to policy information. The bigger theme, as we all know, is there's just policy news coming out, and overall market investors globally and at home, everybody's reacting to the uncertainty around the policy. They just don't know how to process what's going to happen next, what's happening right now, and its long-term impact. And so we've already seen GDP expectations go down quite a bit for Q1. I think projections are somewhere between 0.1 to 1.5%. I've seen different shops project different numbers. They're much lower than Q4 already, and recession probability is already in the book. Some are saying there's a 40% chance. Some are saying even higher. But again, that's also changing as especially trade war related rhetoric kind of changes day by day. And that's also, you've all probably heard, we've had the Liberation Day with a broad tariff numbers were given out, but then since then, some exemptions were made, then retracted, then adjustments were made, negotiations are happening. Too many things happening with tariff to fully process, but as things currently stand, policy uncertainty remains the biggest concern in the market. What that did is, one of the reasons why U.S. market typically behaves or has a market valuation premium to emerging market or other non-U.S. market is that there is a certainty to what the policies will be, and that seems to be going away. So some of those premiums are being questioned. Another thing there's a lot of talk about in the market is whether we have seen a big U.S. equity market run up over the last several years, especially the last 2 years, with especially the Magnificent Seven doing really well in 23 and 24. Now the question that's being asked is it fueled by debt? As U.S. debt keeps going up, is it other the trade deficits that we're running? Is it resulting in more cash available globally that's being pumped into U.S. and driving? So there's a lot of that conversation, and there isn't a lot of clarity around it. There aren't hard and fast data we can look at that can confirm. However, those are the kind of things people are discussing in the market. The result of that, all that is, there is some recession fear, but it's not in the hard numbers yet. It's in the soft numbers, not in the hard numbers yet. Hard data, for example, unemployment claims have not jumped up yet. Although then there are soft data like CEOs are coming out and saying they believe in recession, even though we're not seeing hard numbers. Auto sales is usually an indicator, and April numbers were very important to see how auto sales are. March auto sales went up because people were afraid of tariff and they went out and bought a car. So March numbers were not really reliable, but April numbers will be very reliable, and we're looking to see how that will look. Those will be the hard numbers showing us if recession truly is a problem. But there's a survey of CEOs, and CEOs are believing that there may be recession, and that's important because that makes CEOs then decide whether they want to open up that one position they had or stop hiring. There could be a problem with, the number of job availability may drop quite a bit. We already know that in the government, jobs are being cut, and there's some expectation that could go up to 300,000 job cuts. But that itself will not be driving as much as the market and the job availability there. So a lot of data yet to be evaluated to see if recession truly is a fear. Inflation has already ticked up just ever so slightly. Actually, it's maybe more neutral than ticked up in the last numbers we saw, but it is expected to be going up. We saw around 2.4, I believe, or 2.8% in core CPI, but the expectations are that will be above 3% because the tariffs that are still enacted have not impacted the numbers yet. And so it's expected that those numbers will go above 3%. And if that is the case, then the Fed will not be cutting rates or will not. So they're still waiting to see. They're trying to figure out their fight against inflation, which they want to bring to 2% and it's still above, versus recession and growth stagnation is another concern. So they are in that rock and a hard place trying to figure out what the next step would be. So all this is to say we have seen all these market and economy driven factors driving the market. Mega caps have come down quite a bit this year so far, and we're seeing that we'll be seeing that in numbers soon. And then however, the impact of tariffs are also felt by small cap as well, more than large cap. Even though mega cap numbers have come down, small caps are also hurt quite a bit. As you know, tariffs impact the margins, and small cap stocks don't usually have a lot of margin, and so there's a bigger impact in the valuation of small cap than the large cap at the beginning. And then as it goes through, we'll see how it plays out. So with that backdrop, maybe I'll go through slides. I know time is a concern, so I'm going to move a little bit faster here. What you see here is just that what I talked about, the big volatility increase and 2-day declines that we saw in April after the Liberation Day announcement were rather massive. But then towards the end of the week, we saw it also jumped up. The forward S&P 500 returns are still quite high over 1 year, 3 year, and 5 year numbers. If you move forward, and sorry, these are what happened after the decline. So gives you even though there's short-term volatility, we always invest with a look for a longer term, because the longer term still plays out in a way that's a little bit more rational than the short-term movement. This is a rolling 2-day returns showing the decline and kind of gives you in picture format that this is not uncommon. It's happened before and happened in sharper variation in the past. But it's still quite noteworthy how much the Liberation Day announcement drove the market. A quick look at the markets, and this will summarize in numbers what I've just provided in words, which is international markets generally have outperformed U.S. market. In fact, as of last night, I've noticed I was looking at our international fund benchmark and U.S. equity fund benchmark, and the difference between those is almost 15% year to date as of last night. For the first quarter, that's a little bit less, and we see those numbers here. Small cap has underperformed large cap, which is again the same tariff trade war rhetoric impact. And the mega cap numbers, as I mentioned, this is as of the first quarter, down 15% year to date. If you move on, Karen, please stop me if you have any questions. I'm trying to kind of give an overall view, but also go through the slides. So I'm moving fast, but please stop me. Okay, Karen, let's take a look at the next one.
Yeah, just one thing I'll add is, so the EFA index through yesterday year to date was up 8.8%. Emerging markets, roughly the same, about 1.7%, 1.66%. S&P 500 it's down 8%. So as Raj mentioned, it's still a pretty big disparity, which we have not seen since the 1990s. The disparity between U.S. and non-U.S. Equities. So.
And this is the 4P ratio we've seen in the past, and just shows how valuations for U.S. equity market as measured by S&P 500, it's been very rich, as you know, driven mostly by those 7 names in particular, and one name stands out above all, NVIDIA. But we've seen that come down, and those magnificent 7, as well as the overall equity market, has taken a little bit of a hit in Q1 of 2025, and we've seen that valuation come down. It's still quite overvalued from historical standards perspective, but you can see the little dip there. If you move to the next slide, Karen, this is the valuations and what's driving it. Here we see that on the left-hand side, the PE ratios, which is a good measure of valuation, historically speaking, shows that the top 10 names are the ones that are driving most of it. So the black line here is S&P 500, and the green is just the top 10. So if you take those top 10 out, you can see how the remaining 490 names aren't really driving the valuations as much as the top 10. On the right-hand side, top 1, we see how concentrated the S&P 500 became because of those top 10 names. It's the top 10 weights went up to historically high levels and have since then come down a little bit. But as I mentioned, small caps have also been hurt. So we are not seeing the weight change as much. Valuations have dropped for both top 10, but also the remaining bottom, the lower names. Although when I say small cap, S&P 500 is all large cap here. But generally speaking, if the same chart existed for Russell 3000, which has small cap names, you would not see the weight drop as much. The Magnificent 7 have about given up a year's worth of profit here, is what this chart's showing. If you compare April 24 to April 25, and you see all the names, and it's a little busy chart, but really if you look at the dark blue, it is navy blue line, that's a composite of all 7 names, and that's almost down to where it started a year ago, if you not normalize it to $100 or so. And here I'm not going to spend much time, but it's the same valuation story here. The Magnificent 7 valuations are at their lowest level since 2022, which is not a long time. The valuations have dropped for the 7 names, led by Tesla and Apple. All of these names have been hurt, but again, the numbers are still quite high. Here we're looking at intra-year declines, and this is a good chart, a little busy chart, but really one that I gives me some comfort when I see this, because when markets have a really bad time in the market, it's good to remind ourselves that sometimes intra-year declines can be quite sharp while the year does not end up that way. So in here, the bars represent each year's performance, and then the red dot along the same column represents their intra-year decline. So if you just looking at the last year, 2024, the markets were up above 20%, but there was a red dot that's around -8%, and that tells us how intra-year there is a big decline, but then the year ends up positive. We are currently seeing as of April data as of April 7th, the S&P 500 returns are near the year-end low, and maybe it will recover. Maybe it goes down a little bit. We don't really know, but these kind of intra-year declines are not uncommon, and that's really what this chart is showing. If you move to the next slide, Karen, this is where the U.S. versus non-U.S. valuation comparison is kind of, and basically what we saw in the numbers in terms of international markets doing better than U.S. so far this year. We have seen some of that relative valuation shift happening. We've been looking at this data point quite a lot recently, because we've seen how U.S. valuation premium versus international had gone so stretched, historically speaking. This chart shows the US typically trades at a premium, international trades at a discount, but those numbers were trading at almost 2 standard deviation from their usual average. Average is about 18% discount, and we have seen that gone all the way down to 33%, but then has caught up a little bit. But historically speaking, they're still not anywhere near their averages yet. If you move to the next slide, and this is the.
I'm sorry, Raj, just a quick question. From a couple slides ago, I was seeing the PE, I believe, at about 18. The historical average is 15. So are we still saying that our equities are still overvalued? I know there's a lot of volatility, but we're still kind of saying we're overvalued. Did I read that right?
That way, Stephen. Yes. The U.S. equity, you're talking about just the U.S. or
yes,
right?
U.S. Yes.
Yeah, Karen, you were in the right slide previously. So it appears we are still quite overvalued, even though some of that has come down. The 30-year average PE, the S&P trades at 16.9, about 17 times their earnings. Today, we are trading above 20 still, and that had gone up to 22. So that kind of gives you a sense. We are the S&P is trading at a value that's 20 times its earning, driven mostly by those top 10 names and top 7 to be specific. And the slide I was about to shows almost one name had a lot to do with it, which is NVIDIA. NVIDIA's PE ratios, which I don't have off cover, has gotten really high because it's trading at future expectation, the growth. It's expected to deliver on the AI promise quite, at a robust scale that's almost hard to fathom. But if you take out NVIDIA from S&P 500, just to play that whole, how well diversified is our S&P 500, and you can see that's S&P 500, that black line, ex NVIDIA, it's actually trading below what we see in Europe or Japan. And S&P has beaten those over a long period for quite some time now.
So one could not deduce, let's say, that there's an implied another 15. Well, there's no way to know, but it would induce that there could be another 15% reduction if the PEs were to come back to the 30-year norm.
Exactly historical norms. That's, I think,
historical norm.
Yes.
Yeah.
That's the one thing nobody knows is his historical norms change over time too. So we're not
The
going
broad
to.
S&P appears to be a fairly, based on what you're showing there, when you take the mega caps and especially Nvidia out, the broad S&P would appear to be in a pretty solid, relatively solid spot.
The slide
In
was
normal
more.
times, taking out all the uncertainty, the political risk, and all that kind of stuff.
Right, right. And it was a relative to international Europe and Japan. If you take Nvidia out, I don't have the number, but I would still believe it will be above the average. I think those top 10 names, especially the really tech names up towards the top, Apple, Meta, Tesla's come down quite a bit, Google, these names, if you take those all out, it'll get really close. Those names are really driving some of those overvaluations here.
Thank you.
Karen's swift moving of slide is her way of telling me, Raj, keep an eye on the time. So I'm going to keep an eye on the time, but please ask questions. This is what Neil was referring to in terms of the U.S. Treasury. This is the Treasury yield curve, and we're seeing the blue line reflecting the 331, which shows yield curves have shifted down. And yield curves shift down means bond prices are going up, which is another way of saying people are kind of ditching equity a little bit and going towards the safety of bonds, especially the shorter term bonds. Even though we're not seeing that decline much, there has been a lot of money flowing into short-term bonds, shorter maturity bonds. This is the index, bond index, and it's not surprising that commodity index is on top. As we know, gold is now trading at quite a high margin, historically high levels. Inflation Protection Fund benchmark is also doing quite well. There is inflation fears still quite, as we saw, CPI numbers have not reached the target 2%, and there's expectation that those will jump up a little bit. And so it's not surprising that inflation continues to be something people fear, and there is a demand for those inflation protection bond. And the U.S. Ag is a good measure of the U.S. Corporate and government bond, and that so far year to date 2.8%. If you move on, Karen, we can take a look at. So this is a look back at Trump 1.0 term and looking at what happened then in terms of the trade war rhetoric and subsequently what happened. And it's showing that at first markets were also very, very wary of the trade war and what that would do to the economy, but then recovered quite well in 2019. There's a lot of detail here, and it's really hard to read, but really the overall message is even though we're seeing market what some people are calling a tariff tantrum in the news, and it's basically the markets reacting to the tariff fears. But that we've seen that play out in the past, and markets recover. So there is hope that alone will not be driving the market, and other fundamental factors will play a role. If you move to the next slide, this is a little bit more on the trade deficit, and we're going to go ahead and skip this, but this is all information available. Inflation, I mentioned, is something we're keeping an eye on. A little under 3%, at 2.8% is a number I quoted earlier, and it's expected that's going to go up a little bit. Shelter continues to be one of the biggest source of inflation, followed by recreational dining and other services. Finally, here's some information from what our managers are saying. We've as the market has become volatile, and we've seen our equity managers' performance struggle in this environment. We are traveling quite a bit, including internationally, trying to meet with our managers and ask them what exactly is happening, how are they behaving in these environments. And the general message is that they're finding this market environment to be opportunistic moment. They are able to find good names that are also being driven down by the overall market rhetoric and trade war fears, becoming valued at a point where it's a good entry point for them, and they're taking advantage of that. Generally, there isn't frantic behavior, which we like to see. We don't want managers to make a lot of changes just out of fear of what the market is doing and how it may make them look. And so that's generally what we're seeing, that there is some calm and that they're sticking to their process and using this opportunity to enter into those names that they may have considered overvalued in the past. If you move to the next slide, this is the same overall rhetoric internationally. Our managers are a little bit more wait and see because a lot of this tariff news is changing day to day, and they don't want to have a knee-jerk reaction. So assessment of the overall policy and future policy is quite important here in their buying and selling habits. So fixed income managers are both being defensively positioned, and they're managing the duration. They're making sure their sector exposures are a little bit more selective because there will be some sectors that will outperform other in the volatile markets, and there is also trading opportunities even in the bond market in this volatile period. If you go to the next slide, some of our fixed income managers' overall comments are very similar. PIMCO is one of our bigger managers, and they're also saying no dramatic changes, and they want to focus on the long-term value, and that you will see is resonating other managers' outlook as well. If you move to the next slide, Karen, and I think that's it, but I moved a little bit fast, so please ask any questions you may have.
Raj, maybe it's a good time to talk about this slide. And I added in the word equity fund here too.
Sure. This is we've come to you in the past and told you that we are looking at all our funds, reviewing all our managers, assessing them. We have a new leadership, and we have some new team members as well at key positions, and we're basically looking at everything. We're making it, making sure we're not being frantic and just making changes for the sake of changes. We had decisions that are built into our funds that's based off of our research. We're re-looking our research and making sure we still believe in them. And based on all of that analysis, there are some changes that are coming, and we're working towards them. Again, not everything, no knee-jerk reaction. We tried very hard to make sure we are taking our time because these are important decisions. And so there are some changes. New research is added, old research is redone, and we are at this point going to our own fiduciary committee and board in July with some change proposals, and hoping that will then result in implementation in Q3 and on to 2026. There's a lot we want to share with you going forward. We're just at that point where we're now looking for advisement from our own board and making sure they are also in agreement with some of the changes that we think are good changes to make that will make our product even more compelling.
Is there any questions about that?
Thanks for the update on that.
Thank you.
We'll spend a little bit, because I know we want to focus on the individual funds, but this just really kind of gives an overall view. We'll talk about the individual funds on the following slide. So maybe just highlight here, because we don't have a slide for the US Equity Index Fund that's attribution because it's a market fund. So you can see like the returns are relatively in line with the benchmark. The difference is going to be our ethical exclusions. So not investing in alcohol, tobacco, gambling, adult entertainment, private prisons. So the fund removes those where the benchmark includes those securities. So depending how those work, it could contribute or it could detract. And Raj and I will talk in a little bit where our ethical exclusions actually in the international equity fund was a detractor this quarter because international defense companies were up 35%. So not investing in those names did have an impact on that quarter. So again,
Karen, does the index strategy is net of fees versus the benchmark
Correct.
would not be, so fees would be the other difference.
Exactly. And that was my next point. So yeah, thanks, Melinda.
Thanks.
So yeah, it's exclusions and no worries. Exclusions and also the fees, which the fees on this is 23 basis points, 21 basis points. I can't remember off the top of my head, but low 20s. And again, that includes custody, investment management, and the investment advisor fee. So Raj and I are both going to talk about the attribution, contributors, and detractors of the fund. Currently as it stands, we do have that underweight to mega cap. So the top 50 names is really how we look at our mega cap underweight relative to the benchmark. It's not so much the large cap names, it's the mega cap names. And then we do have that overweight to small and mid. And then we have that allocation to private equity and private real estate. Really what's been impacting for the quarter, it was positive that the mega cap stocks did underperform or did not perform as strongly as others. So that was a positive. Also, our allocations to alternatives also was a nice diversifier. And again, a lot of those valuations lag. So you're really kind of gathering the fourth quarter market movements in private equity. So we'll see how exactly in the second quarter, how those first quarter happened. And then our ethical exclusions did detract. And Raj, do you know specifically with the exclusions, what detracted?
Yeah, so in the exclusions, we know that some of the defense names, I think Boeing, we saw. So I think defense names were up. Generally speaking,
just in U.S. and non-U.S.
Yes, and so was tobacco. I think was up, and we didn't hold tobacco, and that also detracted.
Yeah. Okay. And then our, the main detractor was our active strategies. Some of the names in our active strategies that we invest in were negatively impacted by the tariffs and also this sort of artificial intelligence sell-off that we saw. So again, we are seeing tariffs not only impact your asset classes, but also individual names that you are investing in. We did include the 1 year. Dustin, going forward, wants to kind of look at what the historical attribution is of the fund. So we did include the 1 year attribution, and Raj created a slide, which is why I did not have my full screen up, that kind of talks about in the US equity fund. And now when I did that, I lost you guys. So let me just try to make this. So Raj, do you want to walk through this slide? And it really kind of breaks down where, what specific quarters are really contributing to that 1 year underperformance. Right. And then talk to about like what exactly transpired those quarters.
And really, our 1 year number does not look good, and that we're not trying to, in any way try to explain, sugarcoat that number. It's not good. We're disappointed with this performance ourselves, but we wanted to understand where it's coming from. We've seen last year, about a quarter ago, when we showed these numbers to you, our fund was underperforming by 6%. When the market was up 23%, we were up 17% or so. And that number was equally, disappointing for us. And at that time, we talked about what really was driving it. It came from two specific quarters, Q2 and Q4. During those quarters, we had the mega cap rhetoric playing. In fact, Q2 was NVIDIA. If you remember, looking back, most of the article heading started with NVIDIA back then. NVIDIA was really, it was up 27% for 1 quarter, and that's quite staggering. We underperformed at that time by 3.6%. And it was because of our underweight to mega cap names. And then in Q3, we did not see that big of a market cap driven impact, although growths continue to outperform value. Again, Q4, we saw a little return especially after election. We saw a bullish market sentiment, and those, again, mega cap names rallied again in Q4. Coming into 2025 and after the first quarter of 2025, markets were down 4.7%. On a gross of fee basis, we were down a little less. But again, while mega cap names did come down and that helped us, small cap names went down even more. And so it kind of did not help us as much as it would have if we only had a one-sided, but you kind of have to have both sides of the coin. And so we did not see as much of an impact. When we look at the 1-year number, we're still counting those two really bad quarters we had, the Q2 and the Q4. And again, next quarter, that number will drop off, and we'll look at a number that will drastically change, when we drop off a big, negative underperformance number there. So that is kind of roughly why our 1-year number looks the way it looks. It's not great, and we are looking at our managers and asking questions, and we have some changes we want to talk to you about in the near future after we go through those with our board.
And also, I mean, I know some of you that specifically kind of this is your day-to-day life is investing like it is Raj and I. Active management specifically in the US space just has not done well in the last year, specifically in the last year. I think in the last year it was 85% of active managers underperformed the market. Just again, that's been driven a lot by this AI revolution that's been really boosting these top 7 names, which most active managers are underweight those 7 names to try to find, diversifiers, and also try to find the next top 7 names in their portfolio. So it's really been a struggle for active management. As Raj mentioned, we are continuing to engage with our active managers. As he mentioned, we've been traveling the globe. I have not been, but they've been traveling the globe, meeting with managers, and just making sure that we have the best lineup that's part of our funds. And we do expect to see changes on the margin regarding some of the firms that we hold. I also, again, continue to offer Destin, if there's any difficult client meetings that you have, please feel free to ping myself, Raj, Frank, Wa, Jahara, Joe, Neil. We all want make ourselves available to help have some of these conversations with you and your investor. So don't hesitate to bring us in, and we're happy to have the same sort of conversation with them. So please don't hesitate to do that. Looking at our international equity fund, there's been no significant change to the structure of this fund. We did have a manager that we replaced last year. And so you can see we're primarily in line with the benchmark. We do have an underweight to emerging market frontier markets, and with that allocation to private equity and private real estate. So you can see that the fund underperformed the benchmark, and it's primarily been driven by our active strategies and also our ethical exclusions. As we mentioned, we don't expect our ethical exclusions to have a long-term impact on our funds, but there are periods when defense names are up 35% and we don't invest in those names, that it is going to have an impact on that portfolio. Also, our active managers have been impacted by some of their stock selection as it relates to artificial intelligence and also the tariff. So very similar to what we're seeing in the US equity space, we're also seeing in our international equity managers as well. Raj, is there anything you would add to this?
Not much, other than some of our managers are also continue to struggle in international funds, and that's a growth value driven impact. Value continues to do well internationally, and that some of those growth names kind of hurt our managers, and so they continue to show performance that again, they are performing the way we expect them to, but in the environment that's not suiting them, and that's very important to us. We want to make sure we're never surprised by our managers' performance. And when they are, we get on the call with them.
Mm-hmm. And then here's the 1-year attribution. Very similar story for the quarter. It's been stock selection by our, by their underlying strategies. As Raj mentioned, it's really been a value story in international, which has been the opposite of the US. And our international managers tend to be a little bit more growthy, which having that has been a detractor to their performance. And then moving on to fixed income, again, this is a very diversified fixed income fund. You can see we underweight treasuries, which has always been the case in lieu of having allocations, higher allocations to high yield and also non-dollar denominated bonds and our internally managed positive social purpose lending program. So you can see the fund outperformed its benchmark on a gross of fees basis, relatively performed in line on a net of fees basis. For once, high yield actually did not perform as well as the other asset classes. I feel like this is the only time I can remember saying that high yield detracted, because it's had such a great run in the fixed income. But our issue selection by our active managers offset the overweight allocation to high yield that you can see, and the impact that had. And then looking from a 1-year attribution perspective, again, the diversifying strategy, so being underweight treasuries and having the allocation to non-dollar bonds, emerging market debt, and high yield overweight has contributed, as well as the issue selection by the active strategies. As a reminder, this is a 100% active managed fund. So we do rely heavily on the issue selection by our fixed income strategies. So that is what we had planned. Let me stop sharing my screen. I know you had some questions. I may have to leave at 10 because we have another meeting, but Raj, you can probably hang on for a few minutes, and Neil's also able to stay on. So we do want to answer the questions that I know, Sean, you had. And as I mentioned, Raj and Neil are happy to stay on to answer any of those questions that you may have.
Yeah, Sean, do you want to ask your question about alternative assets?
You want me asking these while we're still recording?
Yeah, and we'll cut it where we just finished. So
okay.
That's yep.
Questions regarding the private equity allocation. I know that you had shown that one slide that showed a 7% allocation, but we don't have a 7% overall allocation. So I guess the first question would be is how much exposure do we have to the private?
Yeah, and we can happy to kind of look at your overall allocations and your equity and your balance, and then I can send that as a follow-up today. Okay. Neil or I can send that as a follow-up to everybody, so you know exactly what that is.
Yep. Second follow-up, while we still have got you, Karen. How liquid are those?
Well, they're illiquid. So those allocations are illiquid. I mean, we're invested in strategies that have like a pretty long time horizon, like a traditional private equity allocation. Yep. It's very different from our alts fund because remember, we did launch that separate alts fund that does have that 3-year lockup, and then you have access to your funds without penalty. So these are traditional private equity, private real estate. So you're looking at like 15 to 10 to 15 years of those being illiquid. But because of the size of the fund, we are able to have liquidity if you need to get money out of those funds. We're able to honor that because of just how large the funds are and where we can pull allocations from other asset classes.
So as long as we have a relatively low level, like somebody like the big account that just came out, Dustin, for example, we're able to get those things liquidated just because you're able to pull from other areas in the fund. So as long as there's not a run on funds, that should be relatively okay. The major concern that I have on the private equity side of things is there is no liquidity. And really all I view private equity as is it's just levered equity, and they take the volatility out because they don't take daily marks, they don't take monthly marks. So like you had said, well, private equity was a great great, boom for the overall portfolio in the first quarter. But you're looking at marks from probably like December 31st or something like that. So we don't know what they're marked at right now. And part of the concern that I've had is I'm starting to hear rumblings throughout the marketplace of, PE starting to really kind of struggle. And I think what the administration is trying to do is they're trying to get rates down because we have this huge window of debt that has to be rolled this year. A lot of it would obviously be in the PE space as well, simply because they're so levered. And if those things aren't able to get rolled, if we can't get the rates down to where they are, then we've probably got to, this window coming up, let's say from June until, maybe the following June of, if rates aren't coming down, we've got credit defaults coming up. And credit defaults, are really the issue that created 2008. I'm not near as worried about what we've seen in the equity space as yet.
Yeah.
But the concern that I have is that some of those PE books, could get written down to zero, and what that does to us, because there is no liquidity to pull those things out. So
No.
that's really the primary concern that I have.
My guess is your allocation is pretty low because you
2 to
do
3%.
2 to 3%. And that's what I was
I
going
would
to say,
say.
even because
Yeah.
you added the index fund, which has no private equity, and you lowered your international allocation. So again, that's like kind of pulling those valuations
Yep,
down.
that certainly makes me feel better.
Yeah.
And
obviously I'm
our
concerned we were like at
investments,
600 or 700 basis points all in or something like that.
Yeah.
I still, the concern there, I think, is still there for PE. At least let's say over the next 6 to 8 months. I think it's, the window of getting these refis done is coming fast. So, we'll kind of see how things play out. But that's probably the primary reason that I stay away from PE myself. Is just there's no liquidity there. And if I wanted to lever up equity, I can do that myself and still retain full liquidity. So, I know I've talked about this in the past. I don't like PE. I don't know that anything is ever going to change that. To me, it's just levered equity that, we'll take the volatility out by not taking marks. So you don't really know what it's worth, but, I can get off of that at this point in time. I feel better knowing that we're, a much lower allocation than what I was worried that we were at, but still the concerns are there.
And Sean, I'll send you some follow-up, exactly what your allocation is in your balanced and your equity fund, and then maybe also provide like a holistic picture of what those private equity allocations look like how much is invested in each.
Yeah, I think that would be fine, Karen, just to kind of give us as a committee overall, like what's our net exposure? What dollar amount do we have exposed in the private equity space?
not all of that is PE. I think there's private real estate in there as well. And there's quite a bit of diversification in terms of their payoff. The distribution can go 5-year to 10-year to 15-year, as Karen mentioned. They're liquid, but there's a distribution happening, and it's diversified from that perspective as well.
Yeah, I think some of the concerns that I have on PE would be overlaid into the real estate space as well. Maybe less so, because hopefully those guys aren't, levered to, or more. But, I think the yields and the credit side of things, we'll know relatively soon whether this thing has got the potential to unwind further. So
I know, Karen, you have to go. I can stay on and go over any questions.
Thank you, Karen.
Thanks, Karen.
Yeah, thanks, Karen. So I think if I'm hearing right, page 30 in the presentation, you're going to redo that with our particular allocation between the equity fund and the equity index fund. So the fund allocation column is going to be our combination, and then compare that to is that what Karen was saying?
Absolutely, we can. Yes.
Okay.
We can.
Yeah, that'd really be valuable.
Okay, Neil, you and I can connect later and talk about that. But you want your funds for balanced equity, all of those accounts in this format?
Yes. Of course, we know international. We're going to be international, because that's just the fund. We don't have two different international funds. But if we combine our U.S. equity funds together and come up with that fund allocation column compared to the Russell 3000 index, that would give us the differences that are actual.
I see. So you have the balanced account that has both U.S. equity index, and international. But then you also have the equity account that has U.S. equity index, and international, all three combined. So we can combine those three and give you the total exposure of that.
Okay.
And then there's the other fund that's 100% U.S. equity index fund. There's no alts in there. Aggregate.
Correct me also, to Sean's point, we don't own any private equity, private real estate. Wespath does, and we just happen to have our money invested with you. And because you're large enough, it gives us that liquidity to pull out. And as long as we give you, like for the large Ember Hope account that we distributed earlier this year, we gave lots of notice about it. And that's the benefit of being a partner with you in this way, as opposed to us investing, our own funds in private equity or private real estate. Am I understanding correctly?
That is correct. And we'll, of course, work with you and honor your request. Sometimes, depending on the size, we need a little bit of time because we don't want our managers to need to fire sale to raise money. We want them to be a little bit thoughtful about it. But our public markets make a big portion, and we want to, that is usually the source of our liquidity needs.
Yeah.
Any other question Neil and I can help answer?
I have one question, and I know the PE, the valuation for the Mag 7 or those top 10 account funds are so large. What's the financial stability of those companies? Because I think they have generally pretty good balance sheets. They're pretty healthy companies. They are overpriced. But they're also strong. So I'm curious about whether you envision them to have an enduring high PE ratio compared to their other company peers.
That's a question we have discussed ad nauseum here, because honestly, we tend to look at PE and then do a comparison over historical norms, but it changes over time. History never stays still, and so it's a valid point that the Mag 7 names in particular are quite healthy from their balance sheet. They have earnings that almost so when you do the same weight of earnings of the top 7 with the rest of S&P 500, they're also in the top. They do have the earnings to support it, but then when you look at a price to earning, that's saying that they are not just trading at what other companies are trading at. If their values are supported by their earnings, these top 7 names are a little bit more than that, because there's a future expectation that they'll continue to generate earnings. Well, when you are relying on your pricing based on some future events, the whole Chinese chatbot DeepSeek information, when that came out, there was a quick adjustment. How much more of these future adjustments are waiting, we don't know. And then there are other questions like, okay, so do we even have the capacity to meet the electricity needs to run the data centers, these companies, because they're very tech heavy, they're very data center driven. Do we have the electricity need and the pricing, the value of energy costs? Will they support those kind of data center needs that they have? There are a lot of questions still there. So can we rely on the current high price to earning as a new benchmark for them? There are questions around it. I think to expect them to trade exactly at average may not be right, but to expect them to continue to trade where they are may also be very difficult. And so maybe the answer is somewhere in the middle.
Yeah.
Different analysts kind of have different perspective, and we're kind of weighing those. And this is where having active managers is really helpful, because in a passive investment, they just take exactly what the benchmark holds. There's no asking questions. Is there a new Chinese chatbot that has a superior capability and may upset? And that kind of came out of nowhere. Our active managers, some of them had hedged against a little bit of that. That they know that there's other such AI power solutions are being built elsewhere that could upset, and the demand from just the AI provided by and the chips provided by NVIDIA may not be enough. Things could be done without those more expensive chips. Cheaper chips could also produce some of those AI solutions. So those kind of active management, I think is still there's some value to it.
Thank you.
Well, the other thing is, I don't know how to evaluate all the political risk. We look back historically at down moves and, well, what has the market done 1 year, 3 years, 5 years after big down moves? But we never had the political risk that we have now. We usually think of that as in other countries, and it's increased. I just think of Apple and how it got hit with the tariff news. With all their production overseas. And then Apple or iPhones or some of their products were given exemptions under the tariff. So then the price took off again. And
right.
It's just a lot of uncertainty. So I don't know how they evaluate the political risk in all this.
It is higher now than it was in the past. That I'll tell you this much. When we talk, the policy uncertainty has made the political risk be a bigger factor now. It was not deemed as risky in the past as it is now. But you're right. The U.S. always traded at a premium compared to international because we had political stability, and that is now a question that makes some of the premium is in question as well. Should U.S. always trade at a premium to international when it comes to the stability, policy stability perspective?
Yeah. Okay.
These are questions we are discussing and asking constantly here. The problem is there is no right answer that we all know, but we can always think through and make the most rational decision based on available information.
Okay.
And that information could change in 12 hours. As we've seen, it's like, so Richard, you had made the point on Apple here a couple Saturdays ago, they kind of walked that back.
Yeah.
But then on Sunday, they walked that back.
Right.
And then so you go to this, what was it, Tuesday after hours, they walk back the walk back. And then Wednesday after hours, they walk back that walk back. So it's just, I think it's almost impossible. And the way that I kind of look at it is, from a risk management standpoint, if you can't measure the risk, well, how do you manage the risk? And I think that's what everybody's dealing with right now. So some managers are just saying, well, I'm just not going to do anything, as they had kind of said, because we just don't know. I think that you've got to assume a favorable outcome, because if they leave things where they're at right now, I mean, we're already seeing shipping, on a month-over-month basis down 65%. I mean, we're approaching the COVID lows as far as logistics is concerned already. You run this for a month or two, I don't even know how you measure the potential outcome that you would see to, a lot of the small and mid-cap companies, that do run the logistics, here in the United States. But it's also, it's going to hit the shipping companies. They're owned out of China as well. So it's just, I think this thing's got to get walked back almost completely. I think it was just a very poor rollout, and the communication has continued to be very poor. But the leverage, I think, that was initially thought to be there doesn't appear to be there at this point in time. So I still think, like what you're seeing out of the markets here, they're not moving near as much off of Trump saying, well, we're doing this, never mind, we're doing this. This is happening. Nope, we're not doing that. the markets just aren't moving as much as they were, around the first part of this month. And I think it's just the weariness of, especially within the options market, to chase this thing, and so to see an 8% move in the S&P 500 in 7 minutes, like we were seeing earlier this month. So I think the market's kind of getting to the place now where they're starting to listen to Bissell a little bit more than they are to Trump, and just say, like, it's going to get fixed. It's going to get resolved. It may not happen overnight, but I think it takes a lot of the potential really scary downside, away from the marketplace, at least at this point in time. And it's like it's the law of diminishing returns, and it's being placed on Trump and his back and forth communication. It's not moving things near as much as it had been. But the big concern I would have at this point in time, Richard, is credit, which I think is still 60 to 90 days away from really kind of just getting into that window, that refinancing window. So we'll see. Who knows?
Those are great observations, Sean. And honestly, this was the reason why we always felt a little uncomfortable being, just benchmark-like in terms of how much we allocate. And we try to have, a benchmark allocates 35% of all assets to just 10 names. And we feel a little bit, worried about how much outsized risk we're taking on a few names. Diversification is the only free lunch, we believe, in market, and being diversified really helps.
Yeah, and I think to your point, and Karen had mentioned it on a couple of occasions too, about essentially how bad active is underperformed. It's not just last year. It's not just last year. It's over the last 5 or 6. It's really, anytime outside of, any kind of a crisis moment, active tends to do better in these crisis moments. But the reason that passive is outperforming everything is just because it's getting so big. It's getting so big, and those top 10 names, it's difficult for active managers to take the kind of concentration risk onto their books that's required to just keep pace with the passive side of things. Now, to your point, Raj, as you had mentioned, we're a ways away still from knowing if, any of these recent layoffs, what that's going to do to the unemployment number, because a lot of that stuff is, they're still getting paid. There was a severance package attached to it. Until the severance runs out, they don't run on the unemployment numbers. So, there's a lot of these trailing indicators that we don't have the data yet to know, how some of this stuff is going to continue to move towards these recessionary figures that we may or may not get. But it's crazy. It's just crazy times. It's crazy times. And my expectation would be is that the passive side of things, if this is just a small blip, the S&P drops 20s right back up, by the time we get to July or August, passive's going to continue to do its thing. And, the megas are going to continue to do their thing, because that's where the money is continuing to come in every single month to the tune of $24-25 billion. And 40% of that's going to continue to buy 7 stocks. So, outside of any kind of a real credit event that may take place this year, I think it's hard to see the dynamics of these passive and the last several years where we've seen, this massive growth, and a handful of companies. Something has got to snap that. You go back in prior times where there's been this massive concentration and then it rolls back down eventually. Those weren't good times that rolled those numbers back, into more of a balanced marketplace. So it's a coin flip, I think, at this point in time, as to how this continues to go. But if I had to weight it, and based on how the market's been trading over this last week, it's the same thing that we've seen. Everybody continues to buy at leveraged side of things. So you've got to kind of consider that, status quo just continues until it's not.
Yeah. Karen's actually reaching out to me. I'm supposed to join her in the call. Is there any last question I can answer?
Thank you, Raj.
I do appreciate the time, and thank you very much for having us.
Thank you, Raj. Thank you, Neil, as well. We're grateful for you guys. Have a blessed day.
Thank you.
Thank you all.